Hey, good morning, everybody. It's Monday, February 9th, 2026. I, of course, am Hammer, the founder of Great Products to Help Originators get more loans in 2026. Products like Originator Success, Grab and Go Social, and Rate Sensei. Be sure to check those out. Remember, you can join proposed Fed chief. So, a lot to go over. If you're here this morning, say good morning. Love to have you here. If you're watching the replay, don't forget, give me a hashtag replay in the comments. Let me know that you are here. If you would like a text reminder that I'm going live so you don't miss the show, you can sign up to get that text absolutely free at hmmr.io/reminder, or use this cool QR code over here and sign up for those text alerts. While you're signing up for things, don't forget to sign up for our free email lock advice that goes out each and every weekday morning at www.ratelockadvice.com. That comes out to you from hammer@ratesensei.com. And also, you may want to consider signing up for our text alerts at www.ratetextalerts.com. $7 a month. You don't have to spend a lot of money if you don't really want to get into the candlesticks and all that stuff, and you just want to protect your pipeline, know what's going on each day. We send out a couple text messages as well as alerts when there's repricing risk. So go check those out. Glad to have all of you here this morning. Let's see. Ron Siegel says today is National Rehydration Day, Football Hangover Day, Bagel and Lox Day, and Pizza Day, which may have been yesterday. So a lot going on this morning. Good morning, all. In fact, good morning to all of the live folks. Glad to have all of you here. I do see you in the comments. I'm going to move faster as we get into the meat of it, though, based on the conversation that we had last week. So let's go ahead and get started. We'll jump in. Let's start by taking a look at the technicals. Let me share my screen and show you what we're looking at this morning. Taking a look, you will see that this morning, mortgage-backed securities, the 5.0 coupon, currently down about 6 basis points on the day from the end of day on Friday. Not terrible, but not great. You see the 10-year Treasury is at 4.22. Again, not terrible, but not great. Taking a look on a quick recap what happened on Friday, we can see that here. Let's zoom in on that and see. Let me refresh the page. Won't let me scroll after I zoom. So, okay. So what we're looking at is right here. This is everything that happened on Friday. So here is a recap. Pricing came out around 10 a.m. It was right around 100. You see that we were right here, right around that 100 mark at 10 a.m. as pricing's generally coming out. We did improve steadily through the day, drifted a little bit at the end of the day, but still ended the day better than where we were on when pricing came out on Friday. Now, as far as rate sheets today, you can see there was a big dip in bonds this morning. And a lot of that probably due to some headlines talking about China urging banks to curb exposure to treasuries. That's probably playing at least a little bit of a role in here. You could see that on Friday, the 10-year Treasury yield was at 4.21. So it's a 4.22. I mean, it's not like it's been a huge, but it has improved on the morning. It did open the day today at 4.23. So a little bit of an improvement, right? Didn't we open today? What was the high? 4.24. So it opened at 4.24. So it's improved a little bit since then. Rate sheets today should be similar. With the idea that we were right around 100, we're right around 100. So we've lost these 6-7 basis points, but that kind of makes up for what we gained on Friday. So really, rate sheet should be very similar to what we saw at the end of the day on Friday. That would put us right around that 6.15 mark using Mortgage News Daily as a reference point. Very much in line with where we were the last few weeks. We've seen, take a look at this. You've seen pricing that has been so consistent. And we were at 6.15 not too long ago, a little bit of 6.16s, came up a little bit, and then now it's back down. But that's kind of where we're at. As far as the day, reprice risk on the day is low. When we look at different things that are happening today, we've got some Fed speakers. If we take a look at the economic calendar today, we've got some Fed speakers that'll be out there chattering. Waller, Moran, Bostic, more Moran. Moran is the Trump mouthpiece. Remember, he is the one that thinks that the Fed needs to cut rates. Waller, probably not happy that he did not get selected to be Fed chair. He was in the running for the job. Bostic tends to be a little bit more of a hawk. So we'll see. We'll see where that is. But I don't think any of this going to have any effect on rates or pricing today. So there's really nothing that we have to worry about there. What we do have, more of this week, we've got a lot more going on this week as far as that jobs data. Remember, after the government shut down, man, it is zooming in on me today. Woo! Let's see if I can get it to zoom out a little. But taking a look here, when we look at, last week we had that short government shutdown that did change up the economic calendar and the BLS jobs data. What should have come out on Friday, the 6th, now coming out on Wednesday, the 11th, we will get the BLS jobs data, which is the non-farm payroll, number of new jobs created. We'll get the wage data, and we will get the unemployment number. Tomorrow, we have the new, it's still relatively new, weekly ADP change report that comes in, the weekly ADP report, which markets are paying attention to, especially when we didn't have the other data. But then we also have a bond rollover, which you'll see the effect of that, I believe, on Wednesday's rate sheet. But it won't affect your rate sheets, but it will affect the bonds. So we'll take a look at that. Thursday, we got jobless claims. And Friday, we have CPI inflation data. Again, very rare that we have both the jobs data and the CPI inflation data in the same week. Normally, what was scheduled is that we were going to have the jobs data on Friday, the 6th, and the CPI data would have come out on Wednesday, the 11th. Those were both pushed back due to delay based on the government shutdown. So Ron Siegel said Waller's comments last week were to push for cuts due to underlying problems in the jobs data. He's looking past the BLS and the BLS's report. So yeah, he's been very dovish and looking for that as well. So yeah, we've definitely seen that. And the weekly ADP report is helping predict the ADP monthly report better than other forecasts. So yeah, very true, Ron. Very, very true. So taking a look here, though, I mean, anything else? There's a couple of interesting articles this morning that we'll get into. I'll throw the lock advice up on the bottom of the screen in a minute. Let me just move this over. And the one thing that was a big takeaway last week, we saw a much stronger reaction to the labor market data we did see than I expected. And that kind of sets us up. It shows us that traders still very interested in these reports. We went from a given, remember, it was almost a given that we would see no Fed movement before Fed Chair Jerome Powell left in May. And now markets are starting to price in the possibility, almost a 20% possibility, that we could see a rate cut in March. So that meaning still about 5 weeks away. We're going to have a whole nother jobs report by then. We'll have a whole nother CPI report by then. But I think that we did see a strong reaction and movement last week. This was up to 97%, I think, at one point, at its highest. So, and then by April, same idea, that we're at about 35% chance of a rate cut in April. By the time we get to June, a rate cut's a given. Remember, Powell will be gone by then. It's a 75% expectation we'll see at least one rate cut by June. And markets pricing in very little chance, about a 25% chance that we would keep rates the same. So if we see that move, these are not going to necessarily reflect in mortgage rates, but we definitely do see that stuff move in lockstep. So keep that in mind. Here are some interesting headlines to go over for this week. Let me pop this up here. And then where's my headlines one? Oh, I don't know. All right. So anyway, looking at what we've got going on Bloomberg, there was stocks slip as caution lingers after a volatile week. This one, though, an exclusive article on Bloomberg, China urges banks to curb exposure to U.S. Treasuries. If we take a look here, China urges banks to curb exposure to U.S. Treasuries. Chinese regulators have advised financial institutions to rein in their holdings of U.S. Treasuries, citing concerns over concentration risks and market volatility. Officials urged banks to limit their purchase of U.S. government bonds and instructed those with high exposure to pare down their positions. So they would be selling, which would drive up yields. But the directive doesn't apply to China's state holdings, and that's kind of the key. That is most of the Chinese holdings, I would assume. And again, this is an assumption, but I would assume they're tied to the state holdings. And this, remember, China is a communist country. So the state holding those treasuries is a different story. The move was framed around diversifying market risk rather than anything to do with geopolitical maneuvering, so they say, or a fundamental loss of confidence in U.S. creditworthiness. So, Chinese regulators have advised financial institutions to rein in their holdings of treasuries, citing concerns over concentration risks and market volatility. Officials urged banks to limit purchase of U.S. government bonds, instructed those with high exposure to pare them down. I mean, basically everything we just summarized, right? So is this something to be concerned about? Not yet. Especially because it's not the Chinese government that is getting rid of their holding of bonds. And I think that's the thing you definitely want to take away here is the Chinese government is not selling off bonds, but they are pushing back on their banks for that. So we'll see if that goes anywhere. Another interesting article. Let's jump over. Warsh calls for a Fed Treasury accord and stirs debate in a $30 trillion bond market. This one goes a little bit deeper. There was an agreement struck between the Treasury and the Fed in 1951. I really, these are things that pop up that I never really knew. Again, I'm not an economist, and this is not my passion for here. I just look to see how this stuff affects mortgage rates. Things like this could affect mortgage rates if it shakes up and pressures the yields on bonds. If we see the 10-year treasury yield go up when you see these kinds of headlines, if this were to push up into 4.35, 4.5, that would of course be bad for mortgage rates and pricing. But as we take a look here at mortgage rates and pricing, you can see that they are back up testing that 25-day moving average, this blue line right here. I'm not too worried about that holding us back too far. Last week, we had this big red line when things moved down, things got worse. That's when rate sheets got worse. Tuesday, Wednesday, probably some of the worst rate sheets. And then we recovered. You see green moving back up. Thursday and Friday, these green candlesticks that are over here pushing back up. And basically, this is where we started the week on Monday, and this is where we ended the week on Friday. So after all that movement, you had this sweeping loss and gains, and that's what you saw in the rate sheet. When you take a look here, you see that same behavior. You'll see that it was, we went from coming into the week 6.17, and then it moves higher, then it moves lower again, and ends the week basically where we ended the week before, even a little bit better. So mortgage rates last week were just a tiny, tiny hair pricing better than the week before, even though they worsened a little bit to get there. Now this week, again, we've got that economic data coming on Wednesday. My advice, though, is to go ahead and flow into it because we saw such a strong reaction last week to labor market data, and it was a positive reaction. If this data is soft, I think that we have a really good shot at seeing, pricing improve. I don't think we see rates drop tremendously from here, but we could see pricing improve. And rates could maybe improve an eighth. Especially what we're looking for is a 1-2 punch. If we get some weak softening in the labor market, if we get a higher unemployment reading, if we get less jobs created, those things will help with mortgage bonds improving a little bit. And then on Friday, when we get the CPI inflation data, if that data comes in showing some weakness and slowdown in inflation, cooling in inflation, that would only help rates and pricing. So my advice, I would float everything into Wednesday's report. Normally, I like to lock ahead of the jobs data, but based on that reaction that we saw last week, we saw a big move again in the Fed futures, which started to open the door for the possibility that the Fed could cut rates before Powell does leave office, before he steps down as Fed chair and his term is over. That's a big deal. Up until now, it was figured that there would be no movement. So definitely with that. And let's see what Ron asked. He said, when you look at the CME forecasts, are they cumulative? Does the June number drop if there's a cut before that? Yes, they are. That is cumulative. So that's the forecast for what rates will be by June. So let me pop this back on the screen and we'll go over that again. So when you're looking at these, and I think Ron knew the answer to that. I think he's just trying to throw me a softball and make sure everyone's aware of that. So it's it moves in step, right? So the expectation that there could be a cut in March is about 20%, a little less than 20% right here that we're looking at. Then when we get to April, the expectation that there could be a cut is 32%. An expectation that we could see two cuts or a one big cut, very, very, very low, but there. And then by the time we get to June, again, the expectation rates would stay the same, only about 25%. Most traders are expecting that we would see a rate cut by June, whether it was a cut early, could see a cut in April, but not another cut in June, or it could see your first cut in June. That's going to bring that same result. It's going to bring us here. In order to get here, we would have had to have seen 2 quarter-point cuts. I don't think anybody's expecting a half-point cut, but if we did get a cut in April and a cut in June, then that's where markets are like, hey, there is that slim chance we could see 2 cuts and conditions would bring us here. They're still kind of betting that far out though. So that's what we're looking at with that one. Hope all this helps you, my friends. And again, thank you for joining me. Remember, you can join me live each and every weekday morning. Tomorrow, we're not going to have a ton to go over, but we'll be talking about what to expect maybe with that Wednesday's Fed data. I'm sorry, Wednesday. So used to meetings being in there, right? The Wednesday BLS jobs data. We'll go a little deeper on that tomorrow. And discussing if you would want to lock in anything ahead of that jobs data. Let's see what the market reaction is today. Right now, bonds down just a little bit. I think they could turn and be positive on the day. We'll see what that reaction is. So hopefully you'll join me tomorrow. I'll see you then. Take care, everybody, and make it a fantastic day. Bye-bye.